Collaborating Agents. Today, I'd like to introduce Leon Ezell with Ezell Mortgage Group. He's going to talk to us about non-QM loans and also hit on hard money loans and kind of all the non-conventional stuff. Leon, we'd love to hear about your background, a little bit about yourself, and take it away.
Okay. All right, guys, I appreciate you having me. Leon Ezell. Live down in North Myrtle Beach near Amy. And I'm from North Carolina originally. I still have a home there that I'm actually in today. And been in the mortgage lending space for 30 years. I own a correspondent lender, so we're actually a lender. We're not a broker. Our biggest part of our business is the conventional side as far as VA. We're also one of the top 50 VA lenders in the nation. So we do a lot of VA loans. That probably accounts for about 70% of our volume. We just do a lot of it. I'm a veteran myself, so we do a lot of VA, especially in North and South Carolina. Now, especially with those being, big military states. My company is licensed. We have a company license in 47 states, and I have a personal and a branch license in 7 states. That's from Virginia down to Florida, and then Tennessee and Texas. I've been in the industry for 30 years. We kind of run the whole gamut. We do FHA, VA, USDA, all the conventional products, rehab loans. So we kind of cover the gamut. I know specifically today you guys were wanting to learn more about the non-QM side. And so on the non-QM side, we do broker that. So we're not a lender on the non-QM space. We're a lender only on the government and conventional sides. Like, for example, we're a direct VA lender. So we're direct with them. And in essence, what that means is that we do not have additional lender overlays. We underwrite directly to VA guidelines. Same thing with FHA. We underwrite directly to HUD guidelines. So, but on the non-QM side, hard money, all of that sort of thing, we do that strictly as a broker, primarily because of the risk that's involved with those types of loans. So we strictly broker those only. So, as far as jumping on into the non-QM space, I would say probably the 2 largest non-QM products are going to be the DSCR loan and the bank statement loan. So the bank statement loan can be primary residence, second home, investment property. You can utilize that for all of those. Those are primarily for self-employed borrowers that are not necessarily claiming enough income on the tax returns to be able to qualify conventionally. Realtors, Kat, fall into that category quite a bit. But I would say that's probably the biggest buyer pool for the bank statement, or self-employed borrowers. Now they still have to have, decent credit. I mean, the credit can't be in the toilet. The days of really, really bad credit loans are kind of a thing of the past. They're very, very difficult to get done. In fact, we typically do not deal with anything with bad credit. But even on the bank statement side, you typically are going to be looking at least a 620 or higher. Now, depending upon where your score ranges in there can kind of determine, obviously, interest rate, fees. It also can have a determination of what your loan to value is going to be as well. So, but again, in essence, what we do with that is we take the bank statements, typically 12 months of the borrower's bank statements. We'll go back and look at those deposits, and we'll average those, the viable deposits. We'll average those out, and we'll base their ability to repay that loan on those average deposits. Now, what I mean by, eligible deposits are, if it was something like where they just had a fluke where they put 50 grand into an account from the sale of something that was not related to the business, then we exclude that. So it's typical deposits that are made into the business through normal business activities. And then again, we will determine their ability to repay and their debt to income ratio based off of those average deposits. The rest of it is pretty, I would say, generally speaking, it's a little less invasive. For those of you that have been in the business for a while, the mortgage side of things can be pretty invasive. You feel like you've been violated when you get through the other end of a mortgage process. So it's pretty invasive, but these bank statements or the non-QM loans are typically not nearly as intrusive, I guess maybe is a better word. The paperwork is usually a little more streamlined. The whole process, generally speaking, is a little bit easier. Now the con to that is obviously you're not getting as good a rate. You're usually putting in more as far as a down payment, a lower loan to value. Fees are generally a little bit higher as well on those kinds of loans. What we typically see, though, is with a self-employed borrower, they usually do not that they don't care, but that's not as big of a concern for them. A lot of the folks that I see that we do these types of loans for are high net worth guys and gals that own businesses. They make a lot of money. Time's very important. They don't want to deal with a bunch of nonsense. They want to get the money, buy the product, and move on. They don't want a lot of hassle. And so these types of loans are, again, they're a lot smoother, a lot easier, a lot less paperwork, that sort of thing. The second loan that we see a lot on the non-QM side is the DSCR, and that stands for debt service coverage ratio loans. And basically, that is primarily used for investment properties. It can be used in some cases for second homes, but it's predominantly used for investment property purchases. And basically what they're looking at is the amount of rental income or projected rental income on that property to determine. They're also looking at credit. And again, they're also looking at, down payment. But they're primarily looking at the rental income to determine what that debt coverage service ratio is going to be. So, for example, if your rent is, let's say you're getting $2,000 a month in rent, and the mortgage payment is $2,000 a month, your DSCR value is 100. Let's say, let me back up and say a little easier math. So let's say that your rental is $1,000 a month that you're receiving in rent, but your mortgage payment is $1,100. Your debt service coverage ratio is now actually 99. Okay, so and some DSR lenders will actually go down to 75%, which is a little hard for me to believe, but they do. Which means that their mortgage payment can be 25% higher than their actual rental income, and still qualify for that loan. Now, again, they still have to have pretty decent credit. They're usually looking for 640 or higher credit score for the borrower. In most cases, the vast majority of those loans are 75 loan to value or 25% down. Depending upon the credit score, they can go. In some cases they can go up to 20% or 80% loan to value. But in most cases, they're going to be around 75. And those are really your two bigger, as far as your traditional or what we call non-traditional, non-QM. And QM stands for qualified mortgage. So these are non-qualified mortgages. So a normal QM loan is a normal conventional Fannie, Freddie, VA, FHA, those kind of things, USDA. And the non-QM, again, is something that's outside of that. So those are typically not serviced by or dealt with by any type of government agency or Fannie or Freddie. These are usually backed by, in some cases, private money. Hedge funds are really big in this space. So that's usually where a lot of this money is coming from for these types of loans, is from hedge funds and private money. Well, I would say more predominantly hedge funds. So any questions so far? Do you want me to wait to the end, Amy, on this, or take questions as we go, or?
Well, Leon, I guess my question for you is, are these loans considered hard money loans? That's one of the things that I think a
No.
lot of our people didn't know much about.
No, these are not considered hard money. And I can talk more about hard money here in next, but yeah, these are hard money is a whole different category. They would fall more under that QM style, but they're still kind of their own little entity or their own category on hard money. So hard money is basically where they're putting most of the weight into the property itself. They're not putting as much weight into the borrower of that money. They're putting more weight into the property itself. Again, the rates and fees on those types of loans are even higher in most cases than your normal non-QM stuff. So again, they're still going to look at credit. Now, in the past, a lot of hard money lenders would not even look at credit other than just to make sure you weren't in an active bankruptcy or something like that, something that would affect title. But typically in the past, it really didn't look so much at credit. Well, a lot of hard money lenders are looking more at credit right now for the primary borrower. Now they're looking at that just as a placeholder, but most hard money lenders want to close in an LLC or some other type of entity. They prefer not to close in your personal name. So for an investor, obviously that's a benefit, but they will look at you as the borrower. They will look at your credit just to, kind of see if they can even do it at all, but they will close it in an LLC or a separate entity. They prefer LLCs. But a hard money loan, again, they're looking more at the property itself. Most hard money loans are used for rehab projects. I didn't mention this. I'll mention this now, but I'm a pretty heavy real estate investor. I invest heavily. I do a lot of flips. I do buy and holds, Airbnb. I do a little bit of all of it. My bigger game is probably flips. I do more of that than anything else. And I occasionally I will use a hard money deal. I don't use them very often, but I will use them occasionally. But they are on a hard money transaction for a flip. A typical scenario will go something like this, where they will loan you 80% of the acquisition of the home. They'll typically fund 100% of the rehab, not to exceed 75% of the after repaired value or the subject to value. So that's typically how most of them work. Now, there are some that will deviate, maybe 5% here or there, but generally speaking, in the hard money world, that's pretty normal. So again, 80% of the purchase or acquisition, 100% of the rehab, not to exceed 75% of the ARV. Again, that's 99% of your hard money lenders are going to go by that protocol. They're typically interest only loans. There's typically, you can pay principal if you'd like, but they're typically interest only. They will pick their own appraiser to go out and appraise the property. They're pretty lenient. Again, they are looking at credit. They're typically not verifying any type of income or anything like that. They're not verifying any ability to repay, anything like that. They do want to know where the money's coming from prior to. So if you've got to bring, 40 grand to closing, they want to know where the money is, but they're not super specific about where it came from as long as it's in your account. So if your dad or mom or brother or cousin or whatever, put the money in there last week, as long as they can see the money and it's available is really all they're really concerned about. Unlike more traditional lending where they want to know every little detail. Where did it go? Where did it come from? Where's it going? Who sent it? When did they send it? Blood samples, all this kind of stuff. It's it's a little different on that, but they just want to know that the money's there. So that's a sort of the gist of the hard money. And again, it is a good product. Again, some people will get stuck on the rates and the fees, but if you can flip it quick enough and there's enough, I've had conversations quite a few times with folks. I'm like, look, you're going to make 75 grand net and you're hung up over a 10% interest rate. I mean, come on, give me a break. So, so if you can get them past that, and usually if you just have a real conversation with them like that, they're usually like, oh yeah, you're right. And they just kind of move on with it. But it's really not that bad because again, it is interest only. And it's sort of similar to a construction loan to some degree as well, because if you take only the acquisition, you only pay interest kind of like a construction loan, only on the amount that you take. So if you're just funding the acquisition part up front, but it's 30 or 45 or 60 days down the road before you take a draw for any of the rehab money, then you don't pay interest on that until you actually take it. And it's kind of like a credit card. I mean, you're not going to pay interest unless you use the money. So, or unless you don't pay it back on time or whatever. But it is interest only on the amount that you actually pull out and use or draw. So, for an investor, especially someone that's flipping, it's a good product. Again, usually most savvy investors, they don't get hung up on it because they're looking at the end result. I'm going to make X amount of dollars at the end of this thing, and that's what they've got their eye on. So they don't really get caught up in the fees and they just calculate the carrying costs and the fees into their cost of doing business. And then if that still makes sense, then they're like, okay, yeah, let's do it. And that's the way I do it myself, because again, I don't use them very often, but once in a while I will. If I've got a bunch of cash tied up in other projects and I want to go ahead and take down this deal before something closes, I may use them. But I think I used it one time last year. I did, I don't know, 32 flips last year or something like that. And I think I only used a hard money deal one time. And I never even took the rehab. I never took that draw. I just did the acquisition. I funded the rest of it out of cash that I had. I never actually took the rehab. I had about $50,000 sitting over there in rehab money, but I never took it. So I never paid interest on it. So it's kind of funny because they called me several times and said, why don't you take this money? I'm like, well, I don't need it. And I'm gonna have to pay you interest when I take it. So I didn't take it. So that's pretty much the hard money world. One other thing I will mention on this is it's a little bit, it's kind of in the same wheelhouse of loans, non-QM hard money, is a bridge loan. That's something else that I wouldn't say we get a ton of requests for, but I'll get a handful of requests for that a year. And a bridge loan is very similar to it's sort of a hybrid between a hard money and a non-QM. It's kind of a hybrid between all of that. But that would be, I just did one a couple of months ago for a gentleman that wanted to, he was selling a home in North Carolina, but he was purchasing a home in Florida. And all of his money, and he had a very nice home. I mean, this home in North Carolina is probably worth $750,000, $800,000, something like that. And the home he was actually purchasing in Florida was only, I think the purchase price was like $550,000. So we actually gave him 75% of the value of the home in North Carolina. So the lien was actually against the home in North Carolina, and the home was paid for. He owed nothing on it. And he took that cash and went and paid cash for the home in Florida. And so that's how those typically work. So that bridge loan or that loan was against his exit home and not against his, the home he was purchasing. And again, they're usually going to be about 75% loan to value, maybe 70% loan to value. They're typically going to be interest only. Again, fees, rates are going to be a little higher. They're going to be up there around like the hard money kind of stuff. But again, they do serve a good purpose, especially if you found something you really want, but you've got to sell before you can take that down. The bridge loan is a good pairing for that. So it's certainly not for everybody, and it's not for every situation. But in this guy's situation, it worked out perfect. So So that's another one that we see a lot. So again, your DSCR, your bank statement, hard money, bridge loans, those are predominantly what we see. Even in the non-QM space, that's probably 98% of your, there might be some little quirky something or other some lenders got out there that nobody's ever heard of, but 99% of the business in the non-QM space is going to be the bank statement and the DSCR. The DSCR is very popular, especially now, and has been for the last couple of years, especially for investors. It's very popular. So that's kind of a general overview of all that. Again, the non-QM, hard money, the bridge loan, and that's the only other thing that would fit into that category would be like a construction loan, and we do some of those as well. And we'll even do them for a builder as a spec. So we will actually provide, in some cases, we'll provide spec money to a builder for a spec house, which is very unusual, especially in today's time with the markets being a little different and the inflation and all the economic pressures that we're having. Spec money is kind of hard to get. And I dwell in that world quite a bit too with builders. I'm the preferred lender for several builders, like decent sized builders. And so their spec money about a year and a half ago, they normally get their money from the bank through, lines of credit and those sort of things. And when the market started shifting and rates started, going up, and, inflation and, all the other joys that we're dealing with right now, the banks just went, they tightened right up really, really quick. So they cut the lines of credit off and they stopped doing spec financing. So I usually am the preferred lender for the end buyer for those builders, where now they come back and say, hey, can I get some spec money now too? Because, my bank, they don't want to do it. Because the bank's always going to take the most conservative, a traditional bank is going to take the most conservative, stance anytime the economy starts to get a little, a little fuzzy. But they also, not defending, I'm not a bank fan, but they also are, FDIC regulated. So they got your money in there. So they've got to be a little more cautious than, we can be a little more, risky because we don't have your money. We're non-depository. So we're a lender, but we're not lending consumer money.